Peeps, it's the last Thursday in August. I'm smiling because at least the Yankees vindicated themselves. Having been swept at Shea, they come back, win 2 in the Bronx. That's the good news. The other good news is this is Market Call. I'm Guy Adami, joined as always by Dan Nathan. And Wednesdays did I say Thursday? It's Wednesday. It's the last Wednesday of the month too, I think. Or maybe it's not. I don't freaking know. But it doesn't matter because Tom Sosnoff, founder and CEO of Tasty Trade, is waiting in the wings. And then Carter Braxton Worth of Worth Charting will be joining us. I'm all hyped up on something I can't tell you. Today's episode brought to you by our sponsors, FactSet, financial data and analytics powered by Tomorrow. Tasty Trade, empowering the individual investor through content, technology, and know-how. We're powered by Open Exchange. There's another Wednesday in the month. I'm screwing this whole intro up, but I don't care because I'm looking at Dan Nathan, and he looks like Madeline Kahn from Young Frankenstein.
Oh, there you go. I see what you're doing there. Again, Guy, I'm going to have a haircut today. We'll see how it all shakes out. Maybe I'll have less of that sort of I don't know, what do you call it, zebra stripe or something like that. But also, dude, I mean, listen, I'm very happy. I know you've been simping, as our friend would say, for the Yankees, and I know that you don't really love to simp until September for Yankee baseball, but we're almost there. The fact that they went to, as you call it, to Shea, wasn't Shea, and lost 2 last month, but now they won 2 in the Bronx, and they can actually sweep 3 would be remarkable, wouldn't it, guys?
Well, except they don't play 3. It's an off day today here. We call this a travel day in baseball. The Yankees are off to a West Coast trip in Oakland. The Colorado Rockies coming into Flushing. There has never been a more well-named city than Flushing, Queens, by the way. But again, I digress.
You want to flush it. All right, let's do it.
You got the hair going, Dan. You look good.
I know.
By the way, I want to give a shout out to Tom
on.
Sweeney. Listen, for you, I don't know if you're a lawyer out there in the Philadelphia area. Tom Sweeney's one of the great lawyers in that area of the country, probably in the country, who still manages to find the time to watch everything we do.
Well, Guy, are we doing local ads now? Because, we got the corner store down the street. They've been supplying me with Mountain Dew for a week. All right,
let's go. Let's get into it.
But real quickly, what's going on under your left eye here? Like what I'm trying to look in. I haven't seen you in a couple of days. Yeah, let's zoom in a little bit. What happened? And how's the other guy look?
Well, I mean, what I'll tell you is, and Tom Sosnoff probably knows this, I guarantee Carter doesn't because, Carter is a lover, not a fighter, but the story is never as good as sort of the buildup. I will tell you, I'd love to be able to say, I was at a bar the other day, some guy was a jerk to my wife, blah, 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 and I jacked his ass up. That's not what happened. Quite frankly, what happened is I was trying to build a chaise lounge on Saturday, and the top swung open and struck me under the left eye.
Sounds horrible.
Yeah.
All right. Well, just beware of any rakes lying around in your yard after doing that. All right. Let's talk about this guy because, last week Carter came on. He drew some lines on that S&P chart. He said these are very important lines. The S&P 500 got rejected at that downtrend to the penny, the 200-day. He doesn't like the 200-day, but we're just going to use it because it lined up pretty nicely. We had a 4% decline here. And, it's like Friday into Monday were a couple of ugly days, okay? The last 2 days, equities are kind of holding on for dear life at a time where the 10-year U.S. Treasury is at 3.11, guy. We haven't seen it there in a while, right? We thought getting back above 3 was kind of important here. We've seen crude oil now, have a nice little move. You're seeing a lot of houses call, they see 100 in the not so distant future. We're going to hit that with Carter in a little bit. Thoughts on how equities are acting right now? I see Apple and Microsoft, $5.5 trillion in market cap, just unchanged here. So goes the market if those things turn lower.
Yeah, I think for a lot of people today, you're hoping you get this bounce. I'll tell you, and I'm not trying to be too hyperbolic here, but if the market were to roll over and go negative again, we were negative earlier, that's not a particularly good sign given the 3.5 days or so of sell-offs that we've seen. So keep an eye, obviously, on the S&P. I will tell you, Dan, keep an eye on the LQD and the HYG. If they roll over and go negative today, I think that augurs something not particularly. Let's put it this way. It doesn't augur particularly well for the broader market going forward. So today I think is a really interesting, critical day because if the market can't hold the gains, having seen the sell-offs we've seen over the last couple sessions, that's not particularly good.
Yeah, real quickly on that chart that's right next to you there, Guy. We see the red line. That was the downtrend. Carter drew it last week, the 200-day moving average, but that really steep uptrend there. We broke that below that. I mean, again, you and I think we could see 4,000 in the not so distant future, but depending upon what the Fed has to say or what comes out of, they're not going to be saying anything officially, what comes out of Jackson Hole. I mean, obviously that's going to determine, how this market breaks here. The VIX, we've been looking at it a little bit here. It had been in kind of making a series of higher lows since that November low. That's when the volatility in equities really started in the major indices. That was when the Fed pivoted, right, in mid to late November here. Well, we got below that uptrend. And again, I'm not a huge charter of the VIX here, but, if we look at a lot of charts here, this one is a significant gap above it. If we hold above that and we keep moving higher, that's probably how you get the S&P back below 4,000.
Yeah, agreed. And listen, we should bring in Tom because he has some pretty strong views. But again, nobody is suggesting you should trade the VIX, but it's definitely something to watch in terms of where, just what the taking the temperature of the market and what people's sort of appetite for risk is. And that's one of the reasons we bring it up all the time. And I would submit, that the VIX, that, as a teenager was too cheap. Other people say, historically it's probably still too expensive. But as they say, that's what makes markets. Can we bring Tom in? Because I mentioned what a study was earlier. He's probably a fighter, not a lover. How are you, Tom?
I'm definitely not a fighter.
I just said that. I mean, you're. I will tell you what you are. You're cerebral. You look at things differently than most people, and I think that's what helps us here on Wednesdays. I thought it was Thursday. I messed up. But thanks for joining us as always.
Thanks for having me, guys. All right, let's do it.
All right, Tom, again, you made it very clear over the last few weeks, you don't really care or don't have a good sense of what the Fed is going to do or say at any given moment. And again, maybe it has more to do with just the 10-year U.S. Treasury yield, which topped out, a little more than, close to 2 months ago at 3.5%, went all the way down. It felt like in a straight line to 2.5%. And now, for whatever reason, you've been trading. Talk to us a little bit about these psychologically round numbers, right? Like a 3% level. Here we are at 3.1. Are you drawing conclusions about what bonds and yields are doing relative to equities right now? Yeah. I mean, is that a good? Yeah, talk to us about that.
So it's a good point here because I've been making this case as of late. I thought the bond rally from the low 130s and I'm talking about the long bond because everything else, basically everything else trades off the long bond. You could use the 10-year, it doesn't matter. But the bonds rallied from 133 area after the Fed raised 75 basis points the first time, all the way up to 146 after the second raise. It was an incredible rally, ridiculous, almost just under 10%. I mean, just a nutty rally in the long bond, more than we've seen in almost multiple years. But I thought the chance of the bonds getting back down from the 145, 146 level down to 140 was really, statistically, if you looked at the implied volatility there, statistical chance was about 5%. So you're talking about a 2 standard deviation move. In reality, they've dropped all the way to 135, which is we're basically in 3.5 standard deviation territory for that period of time, which means it's not something that's even quantifiable or measurable. What's happened to the bonds in the last, let's call it the last month. Because of that, and I think the Fed is irrelevant at this point, because I think that the Fed has no choice but to follow the pattern of the bond market. The bond market was making it really easy on the Fed because they could raise rates without having any risk whatsoever because the bond market was doing the exact opposite. So it's taking all the pressure off them. Now the Fed's hands are tied again because the drop in the bond market, which means higher interest rates, their inverse prices are inverse to rates. The drop in the bond market has really tied the Fed's hands right now because, all that talk of potentially, not raising again or, even lowering because of what the real market was doing. I think that's out the window, at least right this second. So I think that puts a lot more pressure on the Fed to catch up to what the actual bond market's doing. And I also think it puts a little pressure on the stock market because the stock market, people didn't expect the stock market to go from 4,300 plus back down to, let's say, 4,100. And I kind of agree with you guys and think it has a really good chance of surprising to the downside and surprising it at potentially under that 4,000 level, just because the bonds went so far beyond where they were supposed to go, that I think this market just goes to extremes. So for me, to see S&Ps, to see the S&P drop under 4,000 really wouldn't be much of a surprise given what the bond market is doing. If the bond market had held at 140 instead of dropping to 135, and we're in the 135 handle today in bonds, then I would have said, you know what, I think stocks are good here. But now it makes me a little more nervous.
Listen, I agree with everything you're saying, and we're going to part ways at a certain point in terms of what I think it means for equity volatility, but bond volatility is at historic levels. You just basically, you talked about it in the last month. Look at the last 6 to 9 months. It's ridiculous, the moves that we've seen. I would submit this move north of 3% in 10-year is not because the economy is getting better magically. I mean, quite the opposite. It's because inflation is still a problem. So to your point, this sort of ties the Fed's hands. And, we'll see how it plays out. I guess the good news, if there is good news in this, is that the yield curve, the yield curve is flattening to a certain extent. I think we traded up to almost 50 basis points inversion. We're probably around 22 basis points now. So if you're looking for a silver lining, it comes in that fashion. But to your point, Tom, this move in the bond market is something I think people should watch a lot more close.
Yeah, well, I think it's really hard for most individual investors, Guy, to trade the yield curve. We talk about it constantly, on our network, and only because I think it's one of the best trades on the board. And the yield curve's been steepening nicely the last, let's call it the last, week or so. Maybe the last 2 weeks. It's had a really nice run to the upside, which it hasn't had in like what feels like years. But there's a lot of ways for retail, because I know most of the people watching this podcast are retail investors, and if they're not, even for professionals, it's actually a really easy trade to make, because you can buy twos, which are ZTs, and you can sell tens, which are ZNs, and you can do that any ratio you want. I like to do it on 2 to 1, buy 2 twos and sell 1 10. Or if you prefer the longer term, you can buy 2 tens, which are the ZNs, and sell 1 ZB. Those are all the trades that you just discussed, and any retail customer can do that at virtually any brokerage firm. I mean, you can't do it at certain firms that don't support futures, but every firm that supports futures, these are multi-trillion-dollar products. And so there's no liquidity issues. There's no risk issues outside of, just obviously whatever happens in the market. And anybody can trade the yield curve by buying twos, selling tens, or buying tens and selling 30s. Yeah. And so I really like that trade. And if you don't have it on, if anybody doesn't have it on, I think you're missing something, because I think it's an interesting trade that's at a price extreme.
Well, listen, you know what? I mean, we check out what you guys are doing, you and Bats, in the mornings there, and we recommend that our users check out you guys on Tasty Trade and kind of get a better sense of how you're executing those trades, how you're risk managing them. Here's one that, Tom, we really wanted to hit you on here, because this is, when we speak to like different audiences, we get a lot of questions about, things like stock splits. Sure. So Tesla's got this split. It's a 3-for-1. Earlier in the summer, before they declared it goes X tomorrow. Okay, so on the 25th here, a lot of investors were hoping when the stock was, I don't know, 850 or 900, it was going to be a greater split. So talk to us a little bit how you think of the psychology. I know you've been talking about this with retail for years and years and years, all the excitement about stock splits. It's just, to us, I mean, Guy and I have been talking about it in Fast Money, it seems like forever. There's nothing fundamental, right, whatsoever about a split, but there's always an excitement about it. And I do believe it's one of the reasons why Tesla's hanging in here right now. I don't really see a whole host of other reasons. Talk to us a little bit how you think about it, how you speak to retail investors about it, and how you trade them. Do you take the other side?
I've been incredibly vocal over the last couple of years about stocks not splitting, because it pisses me off when you have like a $3,000 Amazon or a $2,000 Google or even a $1,000 Tesla, because individual investors, I mean, I don't care who you are. There's the average retail size account, let's just call it that's actively trades, is $40,000 or $50,000. And if you have a $3,000 account, 100 shares is $300,000. Fully margin, it's 150. So it's actually, these companies have refused to split over the years because they're just greedy and they want control. They don't want any dilution to their shareholder base, to their voting, and they have been very reluctant just to make sure that the stock stays in the hands of a few institutions. So it reduces volatility. It doesn't make it as tradable, all this kind of stuff. So I've been an advocate for shares splitting in virtually anything. I just like things that are cheaper so they're tradable. The $100 range, the $200 range, whatever it is. If you've noticed, since Amazon and Google split, and even Shopify split, all the volumes in there have gone up like tenfold, and almost tenfold. It's crazy. And so what's happened is everything's become tradable. Tesla's been a little more aggressive throughout the years with respect to splitting. So for Tesla, this is a little more normal. But I think when Tesla splits, it's already the most actively traded or the best markets of any equity that trades that there's options trading on. So I think Tesla is going to become far and away the best trading vehicle after it splits. Instead of being a $900 stock, it's going to be a $300 stock, which makes it much more attractive. 100 shares is $30,000. And when you're trading options on it, a naked option will be $6,000 instead of being $60,000. So I think that we're talking about, from a tradability standpoint, nothing else, just liquidity, capital efficiency, and tradability. These splits are really necessary for retail investors to participate in the markets. You want more retail participation? You split the stocks. And I think it's about time that these companies, for all the wrong reasons, by the way, they're splitting stocks because they think it's going to boost their stock price. They're not splitting stocks because they're thinking they're helping the retail investors, but they are.
Yeah, that's an interesting take. I mean, they're clearly doing it. But to your point, though, I guess it doesn't matter the reasons why.
You're right.
I mean,
it doesn't
that's
matter.
ancillary. I mean, the byproduct is the same. And to your point, listen, we say it all the time. If you have two slices of pizza, if you cut them in half, you still have the same amount of pizza. And that's the same thing here with stocks. But to your point, it gives the ability to trade options around them increases, to your point, almost tenfold. Just the ability to trade around the stocks increases, to your point, tenfold. So I guess on the margins, you can understand why a stock split would be positive for these companies. So listen, I understand the reasons why a lot better, and I will tell you, I think you would agree with this as well, Tom. The advent of options trading over the last specifically 3 or 4 years, I mean, this probably was not nearly as true a decade ago as it is now vis-a-vis options world.
You're right, and when you think about the number of people that can participate with these lower prices, I mean, you just bring tens of thousands, if not hundreds of thousands of people back into the fold, being able to trade, both the equity and there's a reason that people don't trade equities anymore in general, that retail investors don't trade equities, and they've all gravitated towards options, futures, and futures options. And the simple thing is because these stocks are too expensive. I can't afford them. And nobody wants to buy the stupid ass fractional amounts of fractional shares. There's nothing you can do against it. That makes no sense to me. You want to be able to be a strategic, capital efficient investor in 2022. There's no reason. Markets are too efficient for you to just think in terms that are not strategic. And so now this brings Tesla back into a level where, virtually every single market participant can play it. I mean, if you're bullish in Tesla and you want to sell a put spread, because you think the stock's going higher, you can do it for $150 of risk. And if you're bearish, you can sell you'll be able to sell a $2.50, $5 wide call spread in there, and put up, $200 and now, hey, I'm trading Tesla now. So, I mean, it brings everybody into the game.
We got one of the most important companies, and this has really happened over the last 5 years as well. Nvidia is just basically taken the world by storm, and they report today. We're going to throw a chart up. Just thoughts on Nvidia. Dan obviously knows what the implied move is. I have some thoughts here where I think it can go. How are you looking at Nvidia? Are you trading Nvidia?
Yes. So I every single thing that I talk about with you guys, I'm trading it and I have positions in it. So like, the yield curve, Tesla, and Nvidia, the same thing. So Nvidia, I am playing it for earnings and I am playing it longer term, but I'm basically just short premium in Nvidia. My current position is in September, I'm short the 150 puts. Right now, I'm short the 150 puts and the 192.5 calls. It's a very kind of neutral trade, maybe just a couple of short deltas, but I'm basically short a $42.5 wide strangle with September expiration. The expected September move, which is, by the way, we're 23 days out to September expiration, and the September expected move is $18 in Nvidia, but the overnight move, because remember it's Wednesday, so by this Friday, the overnight move is just under $10 is the expected move.
Yeah. So, hey, Tom, so just to break that down, when you just said you were short a push, which would generally be bullish, and you're short a call that would be bearish, but you
Right.
just said, and this is for our viewers here, that when they hear you say, so it's basically short some deltas, that means that you basically have some short exposure. The trade is not meant to be short, betting against the stock going down. The trade is meant for the implied volatility, the price of options that are elevated into this earnings print for them to come in. That's how you make money. You don't have a move greater than that short call strike or a move greater to the downside of that short put strike. If it's within that, then both of those options are going to expire worthless if you held it to that point, and then you take in that premium, correct?
Exactly. The stock is 172 right now, and I am going home tonight with a position on where when the number comes out, I am rooting for it to be inside of $10, either way, up or down. I couldn't care less which direction, up or down.
Yeah.
That's
Yeah,
all I'm
but
rooting
Tom,
for.
so let's talk about this really quickly because we live in a time right now where there's some outsized moves, right? If a company like Nvidia, for fundamental reasons, guided down, missed, and people felt bad about it, there's a chance that it would be down a lot more than $10. The stock is at $172, right? And this is where you might line up some charts and you might see where the bodies are buried and this and that, whatever. How do you manage a trade like that? Let's just say hypothetically, you have a move that is, within it's just blown through your short put or call strike. How are you managing it the next day?
Well, one of the things, first of all, Dan, is that the good news in Nvidia is they've already that damage of saying, hey, we're going to miss or we're going to underperform. That's already out. That's
the pre-announced revenues a couple weeks ago, correct? Yeah.
But the only way, and this is where I differ from most of the people in this industry, because people will tell you, well, I need to stop myself out at this support level. I need to stop myself out at this resistance level, all this kind of garbage. I've been doing this for a long time. There's only one way to defend against an outlier move, and that is simply to stay small. The only way you can defend yourself in this business, genius fails when you get too big.
Yeah.
As long as you keep your position size into a reasonable number that you can afford and that you can deal with the risk on, you can never fail. You can get hurt, but you can never fail. Yeah. And so the first thing to do is keep your position size small. That is the number one key. The second thing is, if I have a neutral position on tonight and the stock opens down more than the $10, let's say it opens down $20 tomorrow, the first thing I do is I take my out of the money calls and I roll them down to either neutralize or reduce the risk on the short put. If the stock opens up, I do the exact opposite and roll the short puts up to the call side. And it's a very simple mechanism of rolling the untested side down towards your tested strike. And that's how we defend the position. But you have to start with reasonable size. Otherwise, you'll get squeezed out. We do not use stop orders under any circumstances.
So one thing
before, I'm sorry, Dan, go ahead.
Yeah, and I want to make one point, Guy, and then I'll let you back in here. So it's interesting what you said about how you set stops and where you do it and mental stops. Okay,
they're all mental, right?
They're all mental. Okay, and that's really important. So I just want to give you a quick update on something. You and I 2 weeks ago we talked about. You were long Robinhood, HOOD. I bought some Robinhood. I set a mental stop in my head. I thought it was kind of a 1 down, 2 or 3 up or so. This is the chart since its IPO. Okay. You see that it obviously gotten bludgeoned and it's kind of been in that uptrend. You see the little trend. Look at the 6-month chart here. What I said to myself on the chart is that if it breaks the uptrend, if you look at the shorter term chart here, then I'm going to sell. And it broke the uptrend and I sold. The stock is still on my radar here, but let's see how it acts in and around that level. So I just kind of wanted to give a quick update, but it also ties in a little bit to how I think about using mental stops.
Right. And I see, we call that like an engagement tool, and that makes you comfortable. So I have no issue with that. Like I don't trade that way with respect to I have my own. I will give you a little bit of research that we've done with respect to mental stops in general. And the way to look at mental stops, if you want the optimal number, is if you're selling something, and I'm not talking about stock right now, I'm just talking about optimal number with respect to premium. If you're selling something for, let's say, $1, your optimal stop point is 200%. So your optimal stop point, if it was mental, would be $3. If you're selling something for $5, your optimal stop would be $15. If you're looking for the number that is statistically most relevant, meaning gives you the best stopping point. But like you said, if you're buying long stock, it's completely subjective. And in the case of your Robinhood trade, listen, you made the call, you decided what you're willing to risk, what you're willing to lose. And when it got past that number, you got out. I mean, Robinhood traded 11.5, then it traded back into the 8 handle. Yep. It's pretty volatile stock.
Tom, before we let you go, real quick, just so people understand, selling a put, as you know, you could potentially be put that stock and become long that stock. I think my sense is, in terms of this Nvidia or any other company, you're probably ambivalent. These become trading tools. So you're not looking to get long the stock necessarily at that level. You at some point would probably just buy back that put at a loss or something like that. Can you speak to that real quick? Because some people think this is, you're making basically a bullish. I would love to be long Nvidia at 150, and that's not what this is about at all.
No, it is not about. It's a great point, Guy, because people say that all the time. I'll sell this put because I don't mind buying the stock at this price. But when that stock gets that price, you do mind buying it there. Mm-hmm. So we don't ever sell options because we intend to buy the stock. I never sell puts with the intent of buying the stock. I sell puts with the intent to make money on my short put. I mean, it's very rare that we get put stock because most of the time we'll either buy the option back or we'll roll it to another month or we'll do something else against it. But the only time I will allow myself to be put stock is if it's like a case like Robinhood, where it's a $9 stock, or it's a Peloton, where it's a $9 stock, or it's Palantir or something, like some crappy $10 less stock. For the most part, if we're talking about $170 stock like Nvidia, there is no chance I'm taking delivery of that stock, and I'm just trading it. And if I lose money because I sold puts and the stock went down, hey, so be it. Keep the size small and try to work around it.
Yeah, and I pretty much knew that answer, but I wanted you to verbalize it so people could hear. Tom, as always, thanks for joining us on Wednesday. Good luck with everything today. We didn't get a chance to talk about energy with you. We will next week without question. Enjoy the rest of the afternoon. And definitely, Tom. Dan, you got to check out Tasty Trade, what they have going on literally all day long. So if you love trading as much as Tom does, or even as half as much, this is a community you want to be a part of, Dan.
No doubt about it. And again, we're getting a lot of great feedback from viewers, listeners. They love having an expert trader like him and someone who just does it all day and night. So we're going to try to break some of that stuff down and get inside baseball. All right, Guy, it is time. Carter has been so patient. But he's a patient guy, isn't he? Kind of a patient guy.
He's like waiting, like in the Muppet Show, those two old bastards that sat out in the mezzanine there in the bleachers.
Yeah, there he is. Oh, he's not. Look at him. Look at him. He looks
those
like
guys were good. Those old.
He looks like
I got a fire alarm going here, so we got everything going.
Are you okay? Is everything okay? Are you okay?
Yeah. Fire alarms just test themselves. There's very rarely fires, as you.
Well, what tested itself? Look at this segue. Was the S&P right up to that trend line, Carter? And my God, you couldn't have done better work. You heard what we were talking about, real quick, in terms of you drew the lines, as you say, the lines effectively drew themselves. It worked. It worked exactly how you laid it out. What are you looking at now?
So we broke trend, the minor trend off the low, and now the fight is on. And my hunch is that the break in trend is the important thing, that we basically work lower.
Yeah. So Carter, last week, I think when we updated that, you said there's an unfilled gap down back to like mid-June, right before that Fed meeting. Maybe we see something to the tune of 3,800. Listen, it's hard, right? When you're trying to play this kind of move, there was that counter trend move, and now a lot of people are kind of coalescing around the idea where the market could come in. We see rates, what they're doing here, but now, man, you're kind of on a hair trigger. Like yesterday, I wanted to talk to Tom about this when the SPY was trading the S&P, the ETF that tracks it. 414, I bought some of the weekly, and those are kind of dangerous, people, the weekly 410 puts. I just thought that 4,100 was a level we were going to hit before we had this Jackson Hole thing kick off, and maybe we saw another 3% or so. But again, if you're buying weekly puts, especially in indices like this, you better be quick, because if you get the direction wrong, on either side of your strike, those things are going to evaporate a little quickly. So again, I'm playing for a move this week to 4,000. I'm going to look to cut them. All right, Guy, your email box burned up yesterday from Worth Charting. What did you see? And it was kind of like he was like, Carter was like kind of living in your head a little bit, huh?
Well, it's what's going on in crude oil. And I got to tell you, again, both of you have done an outstanding job. And, we'll talk to Tom next week about crude as well. But, You all were negative, and that played out. But over the last couple of days, I mean, there's been a change of direction, a pretty precipitous change, and it happened yesterday in the equities. When you saw those headlines out of OPEC, those equities turned on a dime. And I'll tell you, it's just my opinion, Dan, the fundamental case for crude oil has not changed. What changed is the price. The fundamentals around it haven't changed. I think a lot of the sell-off we've seen is on this fear of a global slowdown, which I totally get. The problem with that argument is there's been zero demand destruction. We're still at pre-2019 levels in demand, and in terms of supply, we're not anywhere close to where we should be. So the supply-demand fundamentals set up. We've heard from a number of people. Halima Croft talked about it. Paul Sankey talked about it. So I will tell you, I think there's a leg higher here in crude oil, the commodity, Dan.
All right. Well, Carter, I just mentioned, worth charting. I mean, you put it out there yesterday. It was, you've been negative. You thought we'd kind of get a retest back to those November highs, right? And we did, almost to the penny, as you would say here. So walk us through your thought process here and, how you're thinking about playing it and where you think it could go, crude oil, in the near term.
Sure. So actually, this was a follow-up from last Wednesday. We put out a thing talking about oil and XLE and saying, you know what, we're down to the rebound juncture. Let's get going on the long side. Now that the rebound is here, the only thing to look at, I think, is the trend line. And so we've just yesterday moved above the trend line, in effect, short-term trend line, since the 125 high. And so if you take that, right, what you're looking at, and put it on the longer term chart, you'll see the next iteration. It's not only that, and that was the point of the week ago call, not only were we down at that bounce juncture, now that we have bounced, we've moved above the downtrend line. So two very sort of important things. And you can keep going here, go further back. The point of that level and the point of the week ago judgment was that this is not only down to the highs of the autumn of 2021. But if you look at the next iteration, it was at the middle of the formation that crude has been basically living in its entire 2-year history until the Ukraine war. And we had that blow off top, and we're simply back at the midpoint. So three things all coalescing, three key levels, and hence the judgment to play for a bounce. And commodities in general are a bit better.
I agree with that. I'm with you. And Dan, the way I would play it, and you've heard me say this, but the OIH has been extraordinarily volatile. Went from 175 up to 320, back to 245, which was support, back up to 310, cratered on the back of the commodity. Now we're catching a second wind here. I think this, if we look at a chart in OIH, I mean, to me, this is how you play it. The underlying components basically are three stocks. Baker Hughes to a certain extent, but the two big ones, Schlumberger and Halliburton, both the fundamentals of those companies are better than they've been maybe in the history of the company. Balance sheets are better, they're operated better, and they're at extraordinarily reasonable valuations. And you can look at this chart, that uptrend line still intact. We broke through that prior support level to the upside with that horizontal line. And to me, I think with even just a benign tape in the broader market with commodity going higher, I think the OIH can test those previous highs, not the all-time highs, but the previous highs we've seen over the last year or so, Dan.
Yeah, and I think that volatility is really kind of the opportunity here, especially if you're right on fundamentals. And if Carter is correct on the technical setup with crude, I think that's a great way to play it. And, again, I don't have a position in this name just yet in the OIH, but I was looking at the options. And here's a trade that I kind of liked here. So when the OIH, the ETF that tracks those services names, was $248 today, you look out to October expiration, you could buy the October 260-300 call spread that would cost you about $10. You'd be buying one of the October 260 calls at about $14 and then selling one of the October 300 calls at about $4. Again, the max premium at risk is $10. You have profits of up to $30 between 270 and 300 with a max gain of $30 above 300, losses of up to $10 between 260 and 270 with a max loss of 10 between below 260 there. So again, I like the risk reward of this trade. Again, it's been very volatile. You're risking about 4% of the ETF price. You have a break even up about 8%, which seems like a lot. But again, this thing's been moving around. And then you have a max potential gain of about 12% of the ETF. If it's up about 20% in a little less than 2 months. So again, we always like to think about trade management here. I like to use mental stops. If this ETF were to turn lower and I paid $10 for this 40 wide spread, I'd look to cut my losses if that was worth only about $5, or about half the premium there. And then on the upside, if I had a double, if that 30 wide or 40 wide, excuse me, call spread were worth 20, I might look to take half off and let the rest ride here. So again, I like the way you're thinking about playing Carter's take on crude. Carter, real quickly, Guy and I, you see our lines there on that OIH chart. Are they worth charting material here?
Yeah. Well, here's the beauty of that setup. That same look, independent of the lines, is what Freeport looks like, right? It's what Alcoa looks like. So we're getting a lot of sort of autocorrelation stocks in this area of the market all firming up, having had really heavy losses preceding this recent strength. Just to end on one thing, there is someone who never split his stock, of course. It's $50,000 a share. That's Mr. Buffett. He did that for a reason all along. All the opposite things that doesn't want people to play with his stock. But he did put the B shares up.
Yeah, he did. And listen, Carter, I think I can speak on behalf of the entire audience and Dan Nathan. We're glad that fire drill was, in fact, just a drill. That clock behind you, which you turned over for the reasons that the clock had the wrong time, but you never have the wrong time, Carter Worth. You're always Johnny on the spot, and it's great to have you join us. But that's it for Market Call, Dan, on this Wednesday.
Yeah,
I apologize before. I get ahead of myself because that's what I do. I want to thank Carter Worth, who you see. I want to thank Tom Sosnoff, who you don't. I want to thank our sponsors, FactSet and Tasty Trade. Thank you to Open Exchange for always powering us. We'll be back tomorrow, Dan, 1 p.m. Eastern Time. Stay alert, people.
All right, guys. Thanks, Carter.
Bye.